point, just chime in here. We're pretty familiar with everybody here in the room. So with that being said, we'll go ahead and start. Rate and market outlook here. I got to click the arrows so that it adds the slides in properly. We'll get through introductions. I'm Larry Johnson. I'm a loan officer here with Midwest Bank, and joining me today with the presentation is also Charlie Derry. He's a lender in charge of our Rochester and Southeast Minnesota areas. And then also we have Melissa Olson on board with us. She's in charge of St. Cloud and Waseca with me as well. So we're happy to have them on here as well. Now, we'll go ahead and get into the first real slide here. What is the outlook for 2026 and really what impacts rates? So this is my rate 101 for you guys. There's a lot of things that go into rates. Now, when you see in the media, the Fed is cutting rates, a lot of you probably know this, but your clients will ask this, and they always ask, well, hey, does that mean my interest rate is going down? Well, yes and no. Now, what impacts interest rates are the unemployment rate, personal consumption expenditure reports, which come out monthly, year-over-year inflation numbers, energy pricing, and shipping and durable goods. So now whenever we have some activity going on that impacts one of those areas, that can negatively impact interest rates for us. So if you hear something on the news about a trade war, if you hear something on the news about an expansion of a war on some other geopolitical stage, if you hear about gas prices going up, those are all things that we need to be aware of because they impact rates. Now, when the Fed reduces rates, that's the base rate for all lending, so it does help us out a little bit, and we'll talk about that a little bit later on the 10-year bond. But these are the main things that really impact rates, and these are the things that as bankers we watch, and this is where we have a little bit of an advantage that we're getting some data in that a lot of our peers don't if they're not in banking. So the three types of rates to watch, how we compile our numbers, we look at the 30-year bond, we look at the 10-year U.S. Treasury, and we look at the Fed funds rate. And if we watch those three and we know how to read those charts, we can make some really accurate predictions for folks. Now, are they 100% accurate? Absolutely not. If they were, I'd be sitting in a fancy office in New York. I wouldn't be in Southeast Minnesota here. You know, we've learned to decipher them enough to where we can competently advise our clients on the best time to lock. So watching those three really gives us a summary of what's happening in the markets. Melissa, I'm going to let you touch on this one here. Make sure you're unmuted.
I never mute myself. That's the problem. So one of the things that we specialize in here is the FHLB grant. We've been doing it for a long time, and this is a grant that comes up once a quarter per calendar year. They spread the funds out for the entire year so that it doesn't get used up all in one setting. But typically, those funds are gone within the first couple weeks that they become available. You just have to meet the HUD income guidelines for your county or your state. There's a couple different ways we can look at that. You have to have a 620 credit score or higher. It's forgivable after 5 years, and it can be used with any loan program. So we have utilized that every year. We use up all the funds we're allotted. So we're really good at making sure that our clients that need that down payment assistance can have it. Yeah, so that's one of the benefits of using that product.
Yes, and again, unlike Minnesota housing, it's not a balloon at the end. This grant goes away if they stay in that property for 5 years. So it's really setting your first-time home buyers up for success, and it's a great program. We have a lot of success getting these through, and quite frankly, Midwest every year they give each each entity a dollar amount that you can use for the year, and we've exhausted it every year. We're very proficient at getting these grants through for clients. So if you have questions on that, reach out to Charlie, Melissa, or myself. We'd be more than happy to walk you through that program. Charlie, we've got a new program that we're really excited about here, and I want him to touch base on it real quick. And some of you in your markets, this might be really pertinent to you.
Awesome. Thanks, Larry. So the nursing loan program is a new loan program that we have out. It's currently running from, well, it's currently active. It started beginning of January and it'll go until the end of June. Is that right, Larry?
So I guess we're in the testing phases of a new loan program here.
And maybe before I tell you the aspects of the loan and where the benefit is, I want to tell you why we're doing something like this. So we are a community bank, and I think there's a lot of banks or a lot of other institutions out there can tell you that they're there for their community, but this is an example of how we back that up. So specifically in our Rochester market here, we have the Mayo Clinic, we have the St. Mary's Hospital, we have a large contingent of medical professionals here. And this is an example of a program that we put together just to serve our community. The special mortgage savings, we wanted it to be something that didn't necessarily sound flashy, but really had a lot of substance. And the way that we did that is we've actually taken half of our origination fee that we charge, and we're giving it back to the customer. The reason that that's effective more than flashy, it doesn't sound as cool as a big discount on your interest rate, or other things could definitely maybe sound a little sexier. But what this does is it allows us to take the needs of the individual and then use that savings however it would best suit them. So if we do need to use it in lieu of coming up with some down payment money, or if we do want to actually buy down the interest rate, we have some versatility with how we can use that money. Because the truth is, this is us just forfeiting profit and it going directly back to the consumer. We're not shifting money around to do this. This is just us saying, thank you. Here's a discount for people who qualify. We have really marketed it as a nursing loan program, and the decision-making behind that was there are some doctor programs around the area that are quite good, but doctors get catered to quite a bit. Our nurses really haven't. So this was kind of meant to really be reaching out to the people that might have been overlooked and to give them a fantastic program. With that being said, though, this will work for any medical professional that's customer facing, and it really is a broad list. So please ask us if you have individual thoughts. And just as an example, I've even talked and gotten a PCA approved for this. So we're really looking for this to be available to any medical professional that, again, is customer facing.
Yeah, something we're really excited about. Doctors seem to get a lot of the benefits, and for you guys and your clients, you're going to see more nurses and more medical facing professionals than you will doctors, more than likely, just be out of numbers and averages. So great opportunity. Reach out to us if you have questions on that. It's a great way to get them a little bit of benefit there. So let's hop right into the Fed update. There's a couple of things that we're excited for the 2026 year. Now, I'm not getting political. These are just bank facts and finance facts here. So number one, we're looking at a new Fed chair in May. We don't know who it is for sure. There's a short list of about 4 names. And of those 4 names, we're optimistic for any of them. They're very dovish on the economy, which means that they're interested in looking at rate reductions when it makes sense and when the numbers jive. So we're really excited that we'll be getting that new Fed chair. Again, the voting body is fairly optimistic now. The Fed chair is a voting member, and then there's some governors and other people that rotate in and out. And right now, the mix that is in there is very favorable towards cuts. And so we're excited that with the new chair leading that group, we could see some activity this year. not as much as we would probably like. We might get one cut for sure in 2026, maybe two if with this group here, but I'll tell you why it's probably not going to be much more than that, and we're okay with that. Um, uh, Besant is helping to basically unfreeze a couple of things that are going on with the housing market. He's had a directive from the president to kind of really help the housing market, and three of the executive initiatives that have been rolled out are part of that. So one of the things is Fannie Mae and Freddie Mac are the two large mortgage holding entities in our country, and they're sitting on gobs of money right now. And so what's happened was the executive branch has directed them to put some of those funds back into the bond market. He's saying, hey, invest these funds back in. And what that does is that helps reduce mortgage rates. It's called quantitative easing. The government has done it in the past. And while they've got 200 billion that they're going to be dumping in, and while that sounds like a lot of money, we're talking about $1 trillion market. So it's not going to move it as much as we would hope, but it really is going to stabilize things for the first part of this year. The second thing that's going on, and you've probably heard this on the news, was that there was another executive directive coming down about not allowing corporate entities to buy mass tracts of housing. So in other words, BlackRock goes in, buys a community, and then rents the houses back to clients. That's going to end. So that means that there's going to be more supply for clients nationwide. And it's just houses should be for families, not for corporations. There's other housing that corporations can own. Single family homes shouldn't be one of them. And we think that that's a positive in the market. The third thing that you probably heard about, and we're not sure where it's going to go. It might end up in the courts there, but they're looking at capping credit card interest rates at 10%. Now that's really important for the consumer and your clients, because what that means is that instead of paying 26, 30% on some of that debt, they're going to be paying 10%, puts more money back in their pocket, more ability to save, more monthly budgeting options, which means that they could possibly qualify for more homes. So that's something that we think is a pretty positive for 2026 on the Fed update. So the 10-year note here, I've got some notes in here because it can get a little complicated, and you can read that here. So this is one of the bases that really helps kind of set rates. It's a loan that we make to the government. It matures in a decade, so it's short-term money. If you buy it at 4%, in 10 years you're getting exactly 4%. It sets up stability for the market. And it's the benchmark that really guides other interest rates. I use this graphic from the balance because in one little sheet, you see really what's important about it. So what's happening with the 10-year note? Well, if you look at my notes on the side, Scott Besant is really looking at a target for this year of 3.9%. It's up over 4% right now. And Barry Habib thinks it could get down to 3.8, and that really helps influence mortgage rates. So what happens is that there's some things that are going on, looking at bank deregulation, a couple other things that are gonna help out, some very heady financial stuff, but the long-term prognosis for this year is pretty good on the 10-year note. Our housing forecast, we've compiled a real short list of things from the Minnesota Realtors Association and National Association of Realtors. Home values are showing modest appreciation. We saw that in 2024. 2025, we think that's going to continue for 2026. Modest appreciation, anywhere between 2.5% to 3.5%, depending on your markets. But still, that's better than zero. We're seeing growth. Home sales, we're projecting a rebound anywhere from 5 to 14%. People are starting to come back to the market, and that's a good thing for us. Our clients we think you're going to be a little bit busier this year. Affordability will improve slightly due to growing incomes. Incomes are increasing at a pretty steady pace. Inflation is outgrowing incomes, but housing is still one of the real sound investments. It's outpacing inflation, so that's why it's a good investment for your client. Rates, they're going to remain stable, but relatively high in the consumer mindset. You realize, it doesn't seem that long ago they were 2%, 3%. Clients still have a little bit of that hangover from that, and so they think they're high when really they're really much closer to that 30-year average. So our rate forecast, we're really saying that with the 30-year is going to move to about 5.7 during the last half of 2026. Now, this is an aggregate average. This isn't what we're quoting all of our clients. We're saying best credit, worst credit, what's the midpoint? It's going to be about 5.7. So obviously, if you have a client that has an 800 credit score, they're putting down 20%, we're going to have opportunities to get the much more competitive rates. It's just the benchmark is going to be about 5.7 towards the midpoint of the year to 6%, where we'll be quoting folks and trying to qualify them. We think that U.S. 10-year Treasury can hit that 3.8% mark. One of the experts that we follow is a man named Barry Habib, and Barry's predictions are eerily spot on. His people do the math, and he's really somebody that I think very highly of, and the proof is in the pudding with him. So we think that 10-year is going to hold, which means lower rates for us. So the factors that really influence those rates: shifting economic factors, the recovery in housing demand. Again, we're going to get some positives from that Federal Reserve policy. Inflation is trending lower, and geopolitical shifts. We're seeing some positive things on the world scale. So that's really helping us out there. So long story short, to get here, about 5.7 to 6 is where you can tell folks, will there be an opportunity for well vetted clients to get down to 5.5 or better? Possibly. It just depends on loan amounts, things like that. But that's really where we're heading. We think it's going to be a pretty stable year. We're not going to see the wild ups and downs that we've had within the last 24 to 36 months. And we think that it bodes well for the industry. With that being said, we'll open it up to some Q&A. If anyone has any questions or anything they'd like to shout out while you got 3 lenders on board, please feel free to chime in.
I got a question.
Yeah, Justin.
Hello, everybody. One thing in the headlines I'm just kind of curious about, because my personal feeling in this is it could be amazing. I just don't know if it's realistic. Has there been any actual talk of a portable mortgage, taking your existing loan at a fixed rate, porting it over, blending it with a new rate? Is that even in the cards, in any kind of real discussion, or is it all kind of just talk out there?
Yeah, I think that's a lot of chatter. I've seen a little bit about that, and I don't know enough to speak 100% competently on it. I've seen probably the same stuff you've seen, where it's been in the talks. It's been bandied around the same as the 50-year mortgage, right? Like, there's a lot of guys talking about things that could maybe impact our industry. What we're really hoping is that the current administration will come in and take a real hard look at some bank deregulation, which we think is going to help some things, and that could open the door to those types of products. There are assumable mortgages already out there, but they're very limited, and so giving folks an option, like, hey, if you've got a really good product and you want to leave it with that property or something, and the risk is, and it's re-underwritten, we don't see a problem with that, but there's a whole new set of rules that would probably have to be about that. I think that's in the early stages. I'd be very surprised to see something yet this year, but I think that kind of talk shows that folks are really looking for solutions to make homes affordable and to do things that make sense for the consumer.
Well, I definitely think if they could pull that off with how many people are locked into a 3 or 4% rate, if they could literally take that and then blend it with a new, that would really get the market moving. But like you said, I know it's really early and there's not been a lot more talk on it, but I was just curious if you'd heard anything different. So
yeah, no, we really haven't heard anything concrete on it, and I like the idea of a portable mortgage for the same reason you realtors would like it, is that it's gonna, like you said, it's gonna free up folks that are kind of holding on to that. We know there's a certain amount of people staying in a property right now that maybe doesn't fit their needs the best, just because that rate is low and they're afraid to go, drop that lower rate and get into a higher rate product. But yeah, we haven't heard anything solid on that, but great question. Thanks.
Larry, I have kind of a follow-up on that, and I don't know the answer, but when I've heard about those portable mortgages, I don't think they were going to be retroactive. So I think it would have to be a new loan product that would then be written as a portable product. So I don't think it's going to go back to people who have a 3% interest rate now and just get to kind of, capture that and retain it. I think this would be a new type of product moving forward that might stop future issues like this, where so many people got a great interest rate and stopped moving. if they were portable, you know, in the future, it would help resolve this issue, but I don't think it's going to go back and cover previous mortgages.
Oh, thanks for sharing that, Charlie. Yeah, like I said, I haven't seen a lot of data on it, so I wasn't 100% sure of my competency level to answer that. But I appreciate the input there. That's excellent. That's why we always us lenders here, we always bandy stuff around to each other too, because we all read different things and collaborate quite a bit there. Any other questions you got while you've got us on board about products in general or rates in general? That's just kind of the Cliff's Notes version that I give you, just so that you have a little data to take to your clients. To show that, you know, hey, we're not just throwing numbers out there. We actually we compile this stuff and put it together. There's some math behind it, so I feel pretty confident that if I review this by the end of the year, we're going to be pretty close to what our target rate was. All right. Well, super.
Larry, I have another comment maybe about a previous topic that you touched on here. We do see the reason for optimism with, you know, we do think that there could be a rate cut. We do see a lot of reasons to be optimistic about the year. With that being said, though, if somebody's asking me, should I wait? You know, is it how much rate cutting are we going to have? Maybe this isn't the right time. It's the right time. With one cut that we may get in the near future, it's probably not going to be significant enough to move the needle and kind of be in that holding pattern. And there is enough kind of geopolitical stuff going on right now that it's not a certainty that we get, you know, one or more than one. And so, you know, I just kind of want everybody to see that information, and the message isn't wait for better rates. I really think that we should be advising our people that the rates have come down. We're sitting in a decent spot, and there is some room for optimism, but this isn't a wait until the end of the year or a wait till next year. I would move, and if you find that right property, let's get you in something good, because again, there is some geopolitical stuff right now that makes it not certain, right? We've got U.S. carrier fleets going from Venezuela to Iran right now. Japan's having the issue with their bond market. Right. There is some stuff that's happening that we don't know how that's going to pan out. And so don't wait. Buy your house now.
Yeah, no, Charlie's absolutely right to point that out, and thanks for bringing that to the forefront, because we're saying for 2027 and 2028, if we're looking at a long-term predictions, we're not super optimistic that we're going to see a lot below 5.5. The reason being is that internationally, there is not a lot of appetite for mortgage-backed securities or mortgage bonds at 5.5 or less. And we've tested that market, and international money that's coming in has basically kind of told the Fed, we're not interested in buying that if it's lower than 5.5. So I think that's why you're going to see a very measured approach this year from the Fed with the reductions. If they do one, it's most likely going to be one. Chances of getting two is very, very minimal, but it's out there. But I think we could get one for sure. And again, not enough to really impact them enough to make a make or break decision for your clients. So yeah, now is the right time. We'll see things move about the middle point of the year. I'm thinking the second quarter, things will start to settle in right when we're getting to our peak time here. But yeah, if you ever have any questions, email or call any of us. We'd be more than happy to chat with you. We'll run scenarios for you. And, you know, we send out the weekly emails to my group. Will be going out pretty regular here as far as, you know, kind of what the ranges are and stuff. So any other questions before we let you get back to your day? All right. Well, we appreciate all of you taking the time to get out of your busy day. I hope you have a successful 2026. And we want to thank you for all of the work in 2025 that we've had with you. We look forward to partnering with you again. And we really appreciate you guys joining us here. And let's have a successful 2026.
All right. You guys as well. Thank you.
All right.
Thank you.
Thanks, guys.
Thank you.
All right, I think I have to stop the recording somehow here.